Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, how you going? Phil Tarrant. Welcome to the Pure Property Podcast with Paul Glossop, the crew over at Pure Property Investment. It's expanding this a little bit, trying to get some new talent into the studio. I think people have been getting a little bit fatigued with the current talent. So we've looked far and wide to try and track down the deepening of the team to actually get some more insights and interpretation around it. And we've done a mediocre job in securing it. Joining me in the studio, Paul Glossop, who you all know and some may love, and Aaron Findlay, who is, I imagine, if I remember right, senior buyer's agent at Pure Property. Did I get that right?
Yeah. Buyer's agent strategist.
Straight buyer's agent strategist.
We've had the rest, now we get the best.
Why are we bringing him in?
Well, I just said
Makes me nervous.
Well, I'm trying to replace you first and foremost. That's the starting point, everyone. Yeah. So if you've got any hate mail or anything that you want to reinforce here, feel free, inquiry at purepropertyinvestment.com. All hate mail should go there, and I'll redirect it to Philip.
So last time we got together, we had a bold and ambitious idea.
We did. I got a couple of emails.
Did you?
I did.
So for those of you who don't know, we put the call out there to get behind Australia's tradies, the engine room of the economy, so we're told, and said we're happy to do toolbox talks with tradies to help them on the way for property investing. And we said we'd come out and cook some snags and do all that good stuff. Did anyone?
Mate, we did. We got. I'm pretty sure we got over a dozen. Really? But the irony is that they were all out of the Sydney Basin. And the caveat is it needs to be in the Sydney Basin to start with, just for logistics, because we need to figure out how to get this off the ground. A lot in southeast Queensland, and quite a number in the Melbourne and Victorian market, and then a few down in the Gong, and a little bit up towards the Central Coast and Newey. As well. There was actually a few up on the Tweed, I think, from memory too.
Oh, we could maybe like the Gong or Central Coast is probably.
But it's good to see that there are tradies out there who have tuned this in and thinking this is something that would be valuable for not just them, but the cohort of people on those job sites to start to think and get wise about property investing.
Well, I reckon the tradies are in the plum position now in this particular market. We've spoken about this because we're moving into a sort of manufacturing equity game, right? And tradies are the ideal person to be buying, properties that might need a little bit of love and attention, and be able to fix it up faster, simpler, cheaper, calling in favours and whatnot to do that. So all those traders out there, if you are in a city base, we want to get this going, but you've got some geographic restrictions. How far is too far north? How far?
Mate, you
is
tell
too
me.
far south?
You have about a 4-kilometre radius from your office that you typically only really operate within. So it's probably not me who should be asking.
Mate, I don't want to speak to any Vaucluse tradies.
No, definitely not.
They're not real
really
tradies.
I wouldn't classify them as tradies.
Send your hate mail over there. Proper tradies. Proper tradies.
That'll be some real hate mail.
Proper tradies, and we'll get the Barbie fired up. So I want to do that. I really want to do that.
I do
That'd
too.
Be good. So what is it?
Inquiry at purepropertyinvestment.com. Yes.
EN.
They can just give us a call if they want to just get us on the hotline, 1300 985428, and they can just say, hey, I want to do a toolbox talk at my job site at Cronulla.
Yeah. That'd suit you, would it?
It might suit me slightly.
I don't mind going to the Cronulla. You have to make sure I've got lock nuts on my wheels and stuff because
lock nuts.
Things always go missing.
Cinder blocks.
Things always go missing when I head down to Cronulla. No. Anyway, how you been, Aaron? What's been happening, mate?
Good. Just navigating the various changes, the end of the SMSF lending window. That's I think a lot of clients have found some good value there, and I think may have left it a little bit too late, and no doubt some will miss out in the end. But a great opportunity, but always at the end of the day, if the deal doesn't stack up, we leave it alone. So always worth a shot.
So we're kind of on a timestamp this, but we'll do it for the purposes. We're recording this on a Thursday, the 6th of August.
Yep.
You need to be contracted by
the 9th.
9th/10th, which is
Sunday, Monday. Yeah.
Okay. So there's still people doing deals.
Yep.
Like, so everyone's just going,
as long as Bear Trust is established, etc., and the title's ready to go on for an SMSF resi. Then,
but you can contract and then sort the Bear Trust out.
Depends on which state.
Yeah.
Yeah.
Okay.
Yeah. So it would be high risk if you're going on that pathway, though. If you're not ready to go now, I would say, as of today, when we're recording this, we're certainly turning people away to say resi is not the go, because we don't want people to be in a position where they're paying potentially deposits and obviously legal costs and all these things, and all of a sudden can be told by the bank saying, no, we're not funding this because of legislation changes.
So what's been the dynamics with buyers in this market? Are they all just quick, I need something, just are people compromising?
It's probably been one of the most phenomenal times that I've been a buyer's agent in the last 8 weeks. And it certainly was unexpected, because once this got announced, the assumption was, okay, there's going to be a few people who we thought they've probably sat on their hands and they're thinking, oh, okay, there's probably enough time. And this was probably 2 months ago, right, when this all got announced, 6 to 8 weeks ago. What we probably weren't prepared for is how many people actually obviously were sitting there thinking, oh, I'm going to do it. But this obviously just drew a line in the sand to say you need to do it by this time. And I can say safely as a company, we worked with more people in the last 6 weeks than we've ever worked with in our existence in 12 years. Full stop. And that showed how many people were actually contemplating this. Now, what that also tells us is that, yes, we worked with a lot of buyers to get this done within their SMSF resi space. This was both the establishment of SMSF and then buying a property within an SMSF that was residential. But quite obviously, there would be a huge amount of people who did not go down this pathway because they simply just looked at it to say there's just not enough time. Not that they didn't have capacity, but not enough time. So unfortunately, the government has probably made a decision for people on their behalf, which certainly we've talked about a lot.
Yeah.
But it also means that there is a big opportunity out there still for those buyers who maybe considered it and thought there's not enough time. The commercial window is something that we're now pivoting to quite heavily for these SMSF investors who missed the resi window, because the SMSF commercial space is untouched. So leverage is still very available.
Yeah, and we'll talk about that today. And I think that's a lot of people's thought process, where they go, well, I don't want to give my money to retail and industry funds because they don't do a particularly good job. I want to take control of my own future. Therefore, I'll invest through my own SMSF. Resi's closed down. So I know a lot of people are turning to commercial. I have a theory, and I'll test it with you guys. That
you have more than one theory.
I do.
With your tin hats.
I do. I sit there at home at night.
Foil.
Just foil. Sponsored by our foil. And I reckon, because since we've last got together, the numbers have come out. I don't know if you've seen them, but the government made this decision around canning lending inside of super funds on the assumption that only 4,000 of these limited recourse borrowing arrangements were done every year. And everyone's like, okay, yeah, are you sure about that? Anyway.
Where did they quote that data from?
Oh, it's just the numbers that they use. I can't remember. It's deep somewhere.
Yeah. Gemini.
Yeah.
Same
probably.
place as the $2 a week rental increase.
Exactly the same place.
So, same economists.
All those real smart people in Treasury, the guys with their fingers on
$300,000
their,
a year is
on
their
actuaries,
schemes.
yeah. And a subsequent come out that some association, Australian Finance Association, something or other, I can't remember exactly where they're coming out saying, now it's more like 16,000. So 4 times the amount. So I reckon they haven't really considered the consequences of all this. And we've spoken about beforehand, by drying up of, letting people borrow through their self-managed super fund. That means all those projects aren't going to get out of the ground. 30 to 40% of all new build properties are underwritten by pre-sales by SMSF investors. They're going to have to overturn this. I reckon they're going to have to overturn it, give it a year, maybe 18 months.
I couldn't agree.
They're going to have to sit there and just go, we made a mistake. We're used to changing our mind. We've got a track record of changing our mind. We're going to turn it over.
You guys are cool with it anyway, i.e. the voters, because we do it all the time. This is all just conditioned.
You guys are conditioned now that we change our mind. But I think they're going to have to do it, because they sit there going, well, no one's developing stuff, right?
Well, in the absence of some other large event, interest rates dropping, or people are just tapped out. Borrowing in their personal names or trusts is just very difficult. And a lot of them probably found that when the opportunity to buy through self-managed super came up, for a lot of them, it was probably their only option. Yeah. So I tend to agree there.
And these are going to be, and you guys see on the front line, like, I know it's colloquially called their mum and dad investors. They are. You know,
They literally are.
they're just punters getting by. You know.
Yeah, and that's not going to change. And on that math that you just said there, Phil, if you're talking 16,000 SMSF investors for resi per year, what's that out of 400,000 or 500,000 dwellings that transact a year? What's that, 2%, 3%?
It's not a huge amount.
No, but even if you think you're taking 2% of the potential rental stock out of the market at a time where there's less rental stock being created, going back to this $2 a week increase that Aaron referenced, that the government's referenced, I mean, like you said, mate, I think we've got 12 to 24 months. It just, you can't see how this is sustainable if you want to continue to grow this economy.
Yeah. Well, you know, the Treasurer come out and told us that we've had the most businesses established in the history of the numbers, I think, in July. And then someone went to him, mate, it's not because the economy's in rude health. It's because everyone's restructuring and
maybe liquidators.
Yeah, and they're going, yeah. There's been a lot of new businesses created. It's because of your tax rules.
Yeah,
it's not because everyone's sort of moving into the business.
They're trying to dodge tax, buddy.
Yeah.
I tell you,
Minimise.
it might be coupled with the record number of insolvencies in the next 12 to 24 months as well.
Yeah. Anyway, so we digress, but I reckon that's going to happen at a point in time. The thing is, though, is that, and I was chatting about this the other day with someone. I was at a function the other week, and I was chatting with I won't disclose who it was, but a former Labor senator who was around for quite some time.
Paul Keating.
It wasn't Paul Keating. He was the Prime Minister. and I sort of said to him, I went, he's still involved in the government, and I like to get all views and stuff. I went, what do you reckon about all the housing stuff? And he goes, what about it? And I go, well, everyone's sort of, you know, whinging and complaining about values going down and this, that, and the other. And he goes, That's the idea. He goes, that's the idea. I go, what's all the party faithful thing about it down in Canberra and around? He goes, well, they don't care. Like that was the intent. They're not worried about all this negative noise around it, and that's what they want to do. They actually want to make housing, inverted commas, more affordable. So, you know, you go, well, that's the reality of it all. So I think you got to dial in and strap in and just get used to property not growing at the speed as it used to, which is one of their intent and purposes, and property values are going to keep going down. And they reckon Sydney's fallen 10 in certain areas, maybe another 10.
Well, you know? I mean, if this is the intent, the intent and the outcome will create opportunity. I mean, this is the other thing that really I think people need to hone in on here, is that with downturns creates, good buying opportunities. With high markets creates good selling opportunities. And we've talked about it dozens of times over a decade, that you're not looking at this market ubiquitously to say, is it time to buy, is it time to sell? I mean, you're going to have opportunities in different markets, but when markets soften, it creates opportunities for people to enter. When markets get crazy, like Perth was a great example we talked about. I mean, I talked about personally selling property that I owned in that market only 4, 5, 6 months ago, because the growth had come and we wanted to reposition that money elsewhere. This happens, and this is what good investors should be considering.
Yeah, the question is whether, yes, there may be opportunities to buy, but is the market's going to be so different moving forward that you're not going to get the capital growth that you used to get to be able to apply the same strategy? So you need to be committed to a thesis that says this is just a blip and it'll go back to how it was. But will it go back to how it was? Who knows? That's the problem.
And the question always depends on what was.
Yeah.
I think a lot of the focus is on the post-COVID world, where we had double-digit growth fueled by low interest rates. I think we're probably going to go to a bit more of a rhythm where there's some incremental growth, maybe not so much double digits and more steady, probably more of the 20 teens, when what we would have considered normal, those of us that have been around investing for 10 or 15 years. I think the post-COVID, for a lot of people that came into the market, post-COVID, 2020, 2021, 50% in 6 months, I think that's just expected, and it's unrealistic. It just can't continue.
You need to look at some housing markets like Adelaide, right? Like Adelaide has never really fallen into this sort of peaks and troughs and stupid sort of growth. It's just always...
You just meandered along.
Just meandered along, giving it... Paul's looking for his book right now.
Yeah, I was going to say,
I think
I'm looking for the data. Look, you've expelled me from the bookshelf.
Yeah,
I'll fix that.
You can fix that. I'm sure you got some. You got any left?
There's a couple.
You
get audio as well.
Oh, really?
Yeah.
What's it called again?
Worry about it. Surface Guide to Property Investing.
Where do you keep all
the audio books?
No, where do you keep the audio books? This is you just sort of going, I've got an appointment. In the beginning, there was. I'm sure there's boxes in a storeroom
ready
somewhere.
to go.
Yeah, okay.
There's a couple of storerooms in Melbourne that are distributing as well.
Oh, really?
Oh, we're global.
So just while we're at it, it's not. How do you get it? Like, if you want it,
purepropertyinvestment.com, or you can just Google Surface Guide to Property Investing. You can buy it on all good bookstores, online, and also retail.
There you go. So I think you just kind of. I think Adelaide should be reflective of what a normal market is. Just sort of tips up,
steady.
Gives you percentage.
But I mean,
steady.
it has doubled in the last 5 years, Philip.
Yeah.
I mean,
Adelaide has.
Yeah. So I mean, but you go back to saying, okay, well, if the 20 teens are
Has Adelaide doubled?
Just about.
See, I don't know anything about property.
2020 to 2025, it's done about 85%. Yeah, if you aggregate everything. But if you go back to the 20 teens and we talk about what was a relatively normal decade there, and let's assume a normal decade is sort of that. Let's take the bottom end. Let's say it's 4 to 6% average annual compounded growth, even 4 to 5%. If we go back to saying, is it worth it? And let's assume for the next decade we go back down those numbers, and we enter into a property at 600 grand today as an investor looking at their first investment, probably tipping in 90% to 80% LVR type of scenario, 100 to 150 grand in whether it's equity, cash, or a combination. If you're getting 4 to 5%, then ultimately that will mean that a number will double within circa 14 to 16 years.
Is that what it is, right?
About that, yeah. If you're compounding 4 to 5% and you're getting somewhere in that average. So I guess my question then is if you're an investor thinking I'm going to start with that first step as just a retail investor trying to get ahead and trying to buy for a 15-year outcome, buying a $600,000 asset will be worth $1.2 million in 15 years' time if you get 4 to 5%. And that is a lot lower than the long-term average. So let's assume it really drops down and tracks slightly above inflation for the next 15 years. Well, ultimately that means your $150,000 in initial deposit / cash / equity has returned you in excess of $950 $1 million, or in other words, 8 to 9x in 15 years' time. It will be relatively cash flow neutral when you factor in the first 4, 5, 6 years will be negative, then probably a couple of years of neutral, then about another 4 or 5 years of positive. So the ultimate net holding cost will be about neutral. I mean, the question is, would you be happy with those returns?
Yeah, well, once you've got to get the money out. You don't know what the taxman's going to want at that point.
Well, but even if we factor in what the taxman changes are now with this indexation method, it works out to be from what was about 23.9% total tax you pay on profit. It's going to work out to be, if inflation's around about 3%, it's going to work out to be about 28 to 31% total CGT. So assume you pay another 5, 6, 7% more on your CGT at the end of the day. I'm still very, very happy with those returns.
It's probably a better way to do it than sort of sherping on a building site doing labour, right? But at least
it gives you a reason to do that in the background to say, why am I doing this? Well, it's to ideally diversify into these other things.
And you get a toolbox talk and a sausage as well.
There you go.
So there's
one piece of bread.
One piece of bread. Black and gold sauce.
Folded in half, triangular.
None of those fancy sausages either. It's this bulk pack from
absolutely. We're going Woolies or Coles, and we're going the double decker. The stacked high. Yeah.
Everyone loves them.
Oh,
my kids I try and feed them fancy sausages. They go, can we just go to Bunnings and get
I don't want the carnivore sausages.
No, I want stuff you just have no idea.
If we don't get this off the ground, I'm going to be disappointed. I'm going to be upset. I'm going to be very upset. So I've gone, I want to take control of my own future. I want to set up my own self-managed super fund, and I've missed the window. So you're telling me commercial ain't a bad proposition. What happens if you don't want to do that? How hard is it to sort of wind up a self-managed super fund? If you've created one and it's dormant, is it easy just to close it down and go back to being a investor through the super funds?
Not that I've personally done it, but I've talked to a number of accountants who have gone through that process, and people do it regularly because they had a reason why they set it up, and then that reason is now not available, and they're not happy with maybe plan B. The process is relatively similar to setting it up, where it's documentation, pay a fee, and then move that money back into an industry fund of your choice.
Yeah.
There's cost obviously involved with it and rigmarole, but it's not dramatically complicated.
Yeah.
But I think before that happens, what you really should be doing is stress testing. Well, what is that alternative? And that's sort of obviously what we're now looking at is we've got a number of people who have gone down that pathway but not secured the residential property, and that can't do it based on the lending changes.
Yeah.
The lending changes still sit there for a 70% LVR for the most part for a commercial asset. So if you've got 200 grand, 250 grand that sits in an SMSF and you're looking at deploying that for a 15-year outcome, there are commercial opportunities, sort of that 500, 600, 700,000 and beyond that would fit that criteria quite comfortably.
I want to talk about those opportunities and the size of the commercial market versus the residential market is tiny. It's a fraction. Just anecdotally, Aaron, how are the super funds with people trying to roll in funds into their self-managed super funds so quickly? Were they really slow and delaying? Like anecdotally, were they, because they're not that good at the best of times trying to get money out of industry and retail fund into your super funds? Did they make that deliberately difficult for people in this sort of accelerated buying frenzy of self-managed supers?
Probably no more than usual. Okay. It always takes a few weeks to roll the funds over. But I think the good thing with buying residential through your super is that in the initial phase when you're exchanging on a contract, you're probably going to only need 3 or 4 grand in the first few weeks, and then by the time you have a 21-day finance clause, your balance of 5% is due. By the time you actually need lumps of money, unconditional and then settlement, those rollovers have generally taken place. So even if they were setting it up pretty late in the day, it was still realistic that they could get those funds rolled over. So never easy. They drag their feet, but no worse than usual.
Were you guys putting sort of additional conditions in contracts saying if the funds weren't rolled over in time that you could exit it? Could you do all that?
It's encapsulated in the finance clause ultimately. Yeah, it's still the same thing ultimately. If the finances don't stack up and there's no ability to actually fund it or gain the deposit, it's all rolled into that typically.
Yeah. Okay. So commercial property in super. So I've got commercial property inside of super. I've got resi inside of super. I've always been of the position that you're not really getting a lot of good stuff sub $1 million in commercial. And this is of the position that commercial property is intrinsically connected with business. Business is intrinsically connected with the Australian economy. The assets that you can buy sort of around that $500,000 mark is you're going to have a lot more competition there. Point number one. Point number two, sometimes those assets are a lot smaller and maybe carry more risk, or they're less accommodating to sort of long-term leases and everything connected with it. Maybe that's a unfair positioning of it all, but if people are considering commercial property inside of super now, it's going to be hard unless you've got big balances to be buying $1 million, $2 million, $3 million assets. So you're naturally going to be in that
$500,000 or $1 million range.
Yeah, so give me a sense for the type of assets that sit in that sort of band.
I can think of a property that I'm working on currently, which it's going to be about $440,000. It's a property in Maddington in WA, which is one of about 15 in about a 15-year-old strata complex, concrete. It's actually, ironically, this is actually standalone, unattached in a strata complex, street facing, but it's about 108 square meters, faces street. It's leased on a 3+3 to a building and design company with a mezzanine in it. And that's bringing in about $27,000 a year net, or just short of $27,000 a year net. That is something that's universally useful to quite a number of different tenants. That's a great example of something that's there, that's available, that we're going to buy. And if I look at the math of what you need to tip into that, you're probably talking 160, 180,000 that the actual buyer is going to have to put into that.
Yep.
And it's going to return.
It's cash flow positive, like 27 grand.
Yeah. Mm-hmm. Yeah. Well, it's net 27.
Yeah.
Factoring in 70% LVR, you're going to be probably slightly cash flow positive on that deal for the foreseeable future and ongoing. And then you look at the risk. Now, the risk, and I think commercial, because it's probably more of a newer aspect of investing in Australia for retail investors, which 10, 15 years ago, I don't think we talked about it anywhere near as much as what we do now. The reality is people perceive risk that I think the way we used to perceive risk of buying a 2-bedroom villa in Mount Druitt, people just thought that's just on the nose. Why on earth would I buy that as an investment for $182,000 in 2010? You know, this was the same conversation that was happening then, right? Like, and it happened a lot. You and I had this a lot, Phil. You know,
why are you doing that?
Why are you doing that? The amount of times you had to justify yourself to other people who just would say, why are you buying that?
Yeah.
Why are you buying that townhouse in Logan back in 2017? You know, all these conversations, we've had them to, you know, no shortage of them. And a lot of the time it's because that's what I could afford. But I guess the question is, just because that's what you could afford, should that mean that you buy it, or does it mean that you just wait until you have double that amount and buy something at $1 million? Well, history will tell us that buying something that makes sense at the time you can afford it will always beat waiting 5, 10, 15 years to get the balance up to $1 million, $2 million asset. And the risk is two-sided because, yes, look, at a lower price property typically means it attracts a different type of tenant, but a higher price property with a 3-5 year lease in place, it's high price, there's a higher debt to it, vacancy still happens, and you hold a much higher carrying cost for a higher price debt as and when that property is vacant. And don't kid yourself that because you own a $2 million industrial asset in a blue chip area that once the tenant moves out, the next tenant moves in the next day, vacancy will still be relatively similar. You might get less transition of tenants, but if you're carrying a 6-month window of $1 million, $2 million in debt versus $400,000, $500,000 in debt, it's less for you to actually tip into that asset while you're holding it vacant as well.
Yeah. So I think just inherently a lot of the sort of more affordable commercial assets will inherently be de-risked because you're going to have a lot more people looking to buy those type of assets moving forward. So that'll be a natural equilibrium. But, you know, the example that you used, is much of that stuff around? Like, can you find assets like this?
No. I mean, we do find them. That's our job, right? But I think if you were retailing, looking at commercialrealestate.com and trying to set your filters to say, I want to buy a sub $600,000, 5% plus net return tenanted investment anywhere in Australia, you'll have a very limited results.
Yeah.
So the answer is no. I mean, this property that I was just referring to is an off-market deal that's actually come to us via someone who reached out to us a number of years ago looking to actually buy residential property through us. So these properties come to us in weird and wonderful ways. And it's not just that as the bottom end. I know there's something that Aaron's been working on in the background again recently with an existing client who's looking to sell a separate property. And I can think of another property I'm actually buying from another client, a previous client, who bought a separate property in Logan Lee that we're buying that's tenanted in circa, I think it's going to end up being about $810,000. Again, new 5+5 year lease, and that's going to be just short of a 6% net return in a decent area, decent property, very good lease, very good tenant in place. And you're talking for that type of property, you're probably talking 280,000 that they're going to be tipping into that deal for a circa 6% net return with a 5+5 in place. They exist, but our job is to refine it, to siphon the good from not so good. And you can be more patient because A, the property is just not going to come our way that often, but B, we don't have this time constraint, right? Like we don't have this August 10th deadline. So you don't have to jump at whatever's available, because a lot of people did have to literally just say, look, I'm not going to have this opportunity, so I'll take what you've got.
Yeah.
We can do a lot more specific DD.
What do you like, Aaron, commercial property right now?
I think anything that has enough of a diversity of use, I think, and going to that point about even some of the more affordable properties, they're not going to be a heavy, medical or diagnostic sort of fit out. So something that can be, if it is a shorter lease, the transition is going to be easier to a new tenant. So you are naturally going to get some more turnover in those lower price points and having small businesses. But if it's something where yes, it's going to take a few months, but it's not going to be, you haven't got heavy equipment, you haven't got a huge new fit out to do. I think something in that space would be, in that sort of entry level sub 1 million, I think would be pretty reliable. So.
And you'd be mainly focused on industrial? You won't sort of do office?
No, look, it's not to say that it's going to be categorised to one thing or another. I mean, we can't be necessarily picky or just say it's just going to be one or the other. And there's two folds to that. I think the industrial, to your point earlier, Phil, is that if you're buying industrial commercial property, it does have a a resale opportunity for owner-occupiers probably a lot more readily because the businesses that look at those properties aren't buying the premise for the premise to be a key part of what their business success is.
Yeah.
When you're buying $400,000, $500,000, $600,000 shop fronts or retail or something that basically is going to be reliant on foot traffic or visibility, then that property becomes highly dependent on the business success. So it does depend. And you typically, as a buyer for an owner-occupier, if a property was vacant in that space, a bank's not going to go lend someone the money to maybe start a business in the spot because the spot's great. It's if someone's buying industrial, they've typically got a business that's successful, so then they therefore lend against their business to buy the premise to run the business out of. A bit of a chicken and the egg. So it's a bit more reliant on investors to be the prospective next buyer.
Yeah.
And obviously vacancy then becomes a little bit more risky at the lower end if you're trying to sell vacant because you'll have less pool of buyers. However, to Aaron's point, it actually becomes more attractive typically to tenants because lower entry price, typically less cost to fit out. Usually if it's hospitality as an example, the fit out's there. So it's the next business to come in and say, I'm going to make a go of this. And I'm going to use what's there more or less as is, as opposed to make good clauses, keeping it as a shell, letting them spend $200,000 on a fit out. A lot less likely that that's going to be the case.
The and this is probably more so for an accountant, but from what I understand, that the rules governing investing in commercial and your sovereign fund versus residential are very different. So you can't buy a home in your or a house in your self-managed super fund and rent it to your parents.
Not legally.
Or not legally. Whereas inside a commercial, it's completely the opposite.
Yeah,
so a lot of
it's
business
encouraged.
owners actually buy the asset in their super fund and rent it from themselves.
Yeah, we've bought plenty for that.
Just on that basis.
Yeah.
So this is just not like hardcore investors. What we're talking to here is people who are business owners potentially looking to invest in property. So who's the best tenant? Well, if you've got a good business and you can make sure that you can pay the rent to yourself, that's a really good way to operate.
Absolutely.
You can control it within a bubble.
Yeah, no, I've done plenty of it.
I think it's one of the key differences with residential is that can actually be a successful strategy is, leasing it to your own business as opposed to people who's in residential where they become accidental investors and they buy something to get on the ladder and then they rent it to family or they move in for a while and then move out and it becomes kind of a halfway between an investment and a home and it just doesn't serve either purpose very well. So I think you can actually personalise commercial a bit more that way.
So you got a self-managed super fund set up. You got all your funds rolled over into it. For whatever reason, you didn't buy resi in this race to this sort of August 10th cutoff, but you still want to keep investing. How is it different investing in commercial in your super fund versus resi? Is it largely the same process?
Largely the same. Look, there's going to be more reliance on the lease length, lease type. That's going to certainly be highly reliant on how that's going to fund the purchase because it's going to be, unless you're an owner-occupier, i.e. that business owner that we talked about, if you're just a straight investor, it's going to need to be tenanted and that lease that's in place will determine whether the funding's there and as well as what kind of LVR the bank's going to be prepared to lend you. But obviously our job is to run through those filters to not position properties which just aren't going to tick the boxes, or at least we will have a lot of pre-qualifying conversations with our clients, brokers and banks to actually position the property and say, how are you going to fund this if we position this property? So there's a lot more of that that goes into the front end. But generally speaking, let's assume you bought the property and the property becomes yours. And your property is a good example, Phil, that you've bought in your super fund as an SMSF. Depending on the price, there is a limit that you then have to actually do an ASIC audit annually, which becomes a bit onerous, but that's typically over $1 million.
Yeah.
Sub $1 million, not going to play a part in that. But again, that's your accountant's job and partly yours to provide documentation. But put that aside, the general day-to-day logistics are very similar. If anything, over the long term, there's probably less involvement in the property if you've got a lease that's 2, 3, 4 years in place because the only thing you're really doing every year is having a conversation with your broker, accountant.
Yeah, I found that with commercial and super, it's the easiest assets to manage, right?
Yep.
So it's managed by an agent. They do everything.
Yeah.
And you just get paid.
That's it. Ideally, that's the process.
Yeah. There's a lot less, the XYZ's broken, do you want to fix it? It's all just, it's all done by the tenant, right? Which is Which is really good. So you can actually find good assets in that sort of sub $1 million.
Absolutely.
And I imagine there's more of those type of assets than more expensive commercial assets, because I can't remember the exact number of commercial transactions each year. It's an absolute fraction, right?
Yeah, it's less than 10%.
Yeah. It's a tiny amount. So is every buyer's agent onto this now? Are you already sort of seeing?
I don't know.
Are you coming across?
It's not something I pay much attention to, if I'm
Yeah.
completely honest with you. Phil. Like we don't exactly look at what's everyone else doing, and is this an angle? I mean, we just look at where the need is, and ultimately what's going to make sense for that cohort of investors. And our job is to fulfill what we know is going to be a need, and not available for most, was that resi space, which as much as we saw that was an excellent way to advance people's portfolios and do it safely, successfully, and do it with some diversification. I mean, commercial real estate in that space, in an SMSF, is still going to play a very similar part. And we always assess it. Obviously, there's financial advice that goes with the SMSF setups, and we always look at it to say this is a piece of a broader puzzle. But again, we definitely see this space as something that I think will evolve relatively quickly, and there'll be consistent demand in there from investors and owner-occupiers too, because back to that point of potential business owners who might have considered, I'll set up an SMSF and I might buy some resi and I might buy a premise for our business to run out of. Well, the resi is not an option now. So we might see more owner-occupiers push into that space in a probably more compressed period of time, which I expect will probably see demand increase a little bit over the next 6, 12, 18 months. And if that combines with rates possibly dropping in the next year or two, then we'll see some better spreads in the yield that will come, because essentially your interest rates are less, your net returns will be slightly greater, so the margin should be a little bit better as well.
What wouldn't you be touching in commercial, Aaron?
I'd say probably a lot of office.
Yeah.
I think there is a place for it, but there's probably some smaller regional markets or suburban markets where supply is a bit limited. There's generally pretty good flexibility as far as, if you've got a professional services in there, an accountant or lawyer or whatever that might be, they can, if you do have turnover within a few years, they can come and go relatively easily. But I'd say generally sort of high-rise office, same sort of scenario as the old Docklands residential that we go back to so many times. I think it's just it comes down to supply and in that way. So.
What about new versus old? There's a whole bunch of sort of this tilt construction type, small industrial units.
I think
they're going up all over the joint.
They're struggling. Yeah. If I'm seeing it anecdotally and looking at a number of different markets, that's the property type. And as someone who's built that as well, myself personally, that's a construction type that I think is going to struggle as far as selling it, because they were highly reliant on probably A, investors, but B, owner-occupiers. And a lot of those smaller, anywhere between 80 and 180 square metre tilt slab construction types with a mezzanine that maybe wasn't on title, but they squeeze it in there and can run an office out of it. It was trying to position these properties to people who wanted to get in, but probably got caught up in the hysteria of 6, 7, 8% net returns and 2 or 3% interest rates of 4 years ago. And a lot of these properties started their construction history sort of on that premise that, hey, we're going to get some pre-sales and these things are going to up. But the actual square metre rates of what those things have sold for, we're starting to see now price reductions across the board, particularly those big storage places, which people are buying, the man sheds and the man caves. That's they're the high risk ones from my opinion.
You see there'll be like 20 or 30, 40 of them all in a row, all identical.
And to Aaron's point, what's the alternative use of these things? Yeah. And when you buy something as an investment that has really a very small pool of buyers, just like residential property. If you're buying a property, and I can talk of I spoke to a client yesterday who, and he might be listening to this, and it's no offense to him, but he bought an off-the-plan 9-room housing development in Warrigal, off the plan 3 or 4 years ago. We spoke to him about 5 or 6 years prior to that. And he didn't go with us. And I spoke to him yesterday, and he's got this $1.3 million construction of this housing accommodation in regional Victoria.
Like NDIS or
it's just housing. So essentially just rent by the room.
Oh, okay.
Yeah. So every room's essentially a self-contained studio with a kind of a double-sized kitchen with multiple ovens and fridges, etc. And it's gone backwards in value. And what was promised to be an 8-10% net return has maybe more like been a 3 to 4% net return, because you've got vacancy, you've got ongoing reletting costs, and all the other things that go with it. The use of that property, and to sell that to anyone, who's going to buy that right now?
Yeah.
No one's going to buy it.
It'd be hard to convert it to a family home.
And you can't convert it to a family. Or you could. The cost would be exponential. His negative equity, because what he paid for it 3 or 4 years ago, is not worth what it is now. Cash flow is not there. And this goes back to that commercial space. Be careful buying something that has a very limited use or a very small pool of who's the next buyer of this property.
Real specific use is
it's scary.
Unless it's like, cold storage and all that sort of stuff, which that all that sort of thing.
There's a lot of businesses that
there's a lot of businesses that do that, and there's fit outs and stuff.
But a man cave, but for people to put their collectible, Aston Healy that they bought 40 years ago that they're just reminiscing over and look at
pool
it.
Table up in the mezzanine.
Yeah, and put their signed footy jerseys on the wall and just sit there and have a couple of beers once a month. It sounds amazing, but I'm painting a very specific picture, because that's what these things actually try.
But they're marketed.
They're literally marketed to the boomers.
Yeah.
And when they don't want it, who else is going to use this? Or who's going to rent it? No one.
It's like all these middle-aged men all sitting there on a Saturday, all looking at each other across with their roller doors up, going, "Oh, this is cool."
That's literally what the renders look like, right? They've just got a whole bunch. Hey, Jeff, it doesn't happen. No one's there, and half of them are vacant, and they can't move them.
Yeah.
So careful of that.
Buyer beware. So a
massively.
lot of the same principles apply buying commercial than resi. The scarcity, all this sort of stuff, right?
It's no different. And you just got to think that as the end user, think about that. Don't just look at the numbers, but then take a step back and say, if and when this property is vacant, or if and when I want to sell this property, who can I rent it to? Who can I sell it to? And if the answer to that's relatively logical and straightforward, then you're comfortable with it. But when it's not, I'm nervous.
And most, it's sort of like for resi, more commercial properties will be strata than
absolutely
as a percentage than
especially
resi.
at that price point. You'd have to think 90% of what we're talking about is going to be a strata complex.
So how important then is it really understanding the strata and the strata process and sinking funds and building health and conditions and insurance and all that sort of stuff?
It's pivotal.
Yeah.
And,
so that's all part of the DD.
That's the DD, right? Like, is that spending a fair bit of time making sure there's a good DD clause and having your lawyer be forensic when we go through
so you
contracts.
actually need a lawyer who knows what they're doing with commercial. And there's not a lot of really good ones out there from what I understand.
No. And that's the key. Be prepared to pay a bit more for that advice and be very nitpicking, because the sinking funds, the special levies, any of those clauses that sit there that for a lot of the time it happens in resi as well. But you do have to be a lot more specific there, because if you've got a $25,000 net return on a $450,000 property, that looks great top line, but all of a sudden you didn't see that there's a sinking fund increase that is not part of the lease and the net tenant lease. That's $5,000 a quarter that you're responsible for the next 5 years, and it's not disclosed because potentially it doesn't have to be. All of a sudden you're like, hang on a second, I actually am making very minimal money here. And then again, how do you sell that property? Well, good luck with that. Yeah.
So most people will be naturally contained in the type of assets they can buy in their self-managed super fund, commercial assets inside their self-managed super fund, purely because of being able to get money into your fund. And again, you've got to be pretty careful with the value of your fund, right? Because at a point in time, you start getting thresholds where you start paying more tax. So good accounting advice, Aaron, is probably pretty important with this side of thing, right?
Yeah, definitely.
Yeah. And I think that's that. I mean, this is the part where ideally we're working with people who've already gone down that pathway to get the SMSF set up, make sure that they understand the parameters, understand that from their broker's input what the borrowing can and can't be. And once we know all those things, our job is to fulfill the order. And the orders are there. I mean, to your earlier question, Phil, that the opportunities, they definitely exist.
Yeah.
But, if we're talking outside of the SMSF and you're going to close it down, it certainly goes back to that window that I'm a big firm believer that the next 6 to 12 months is really, really, really amazing times to be a buyer.
How are commercial agents compared to resi agents? Are they easier to deal with?
I think from my experience, they're a lot more cutthroat, right? Because there is very little emotion involved in any of the transactions that happen in commercial, generally speaking. There is no one who sits there to say, oh, I raised my family here, or we have so many memories of that birthday there.
Yeah.
It is literally just, here's a square metre rate,
Numbers.
this sold for that, this lease is in place, they're going to renew, they're not going to exercise their option. These are just factual conversations. That is basically all it is. And most of the time, the vendors are very aware of all these factors as well.
It's much easier to determine value, right? Because it's normally a product of the lease and
Absolutely.
the extension of the lease. So this is how, you go about. Yes, you can sort of structurally manufacture value in commercial assets, whether it's maybe putting a mezzanine up properly, or actually even getting mezzanine in place, put on a plan.
Car spaces, outdoor use,
you're playing around
operating
the fringes.
times.
Yeah, operating times. Like, is other ways to add value, but the best way to add value to a commercial property is just getting the rent uplift.
Yeah,
right.
Get the rent up quickly and have minimal outgoings, and the next buyer is going to do the math on those numbers.
Yeah,
and that determines value.
Okay, good. So this might be a new concept to a lot of people. You guys are happy to talk to them about it, sort of explain it, understand it.
Yeah, it's a key part, I think, of the next few months for us is to have more conversations about it, because we want to be here firstly to educate, because it's not going to be for everyone, both on what people want with their risk and their tolerance, but also what they can actually physically do financially, and then also have those conversations with brokers around that space as well. And a shout out to accountants who might also be listening, who maybe have SMSFs they've set up with a lot of clients and they're thinking, well, what do we do now? We're happy to have conversations with those clients about what can and can't be done, and what we're seeing is probably realistic, because our job's not to talk everyone into this. It's certainly to play a pretty level playing field, but we want to make sure that people are, if they're going to make this decision, they do it with confidence, as opposed to just saying, because my buyer's agent told me so.
Yeah, and I think importantly also, don't feel as though you've got to keep contained inside your self-managed super fund with commercial. So outside of super, the funding requirements are different. The loans you can get are different. Serviceability is different.
Yep.
Like, you might be tapped out in some aspects buying resi, but the type of funding you can secure against commercial assets, lease stocks and all this sort of stuff, it can potentially be the way you can step up or keep manoeuvring through your portfolio. So you guys can talk about that
Absolutely
outside of super as well, right?
Yeah.
Very good. Nice. All right. Well, thanks for coming in, gang. It's good to see you.
Thanks for having us.
Welcome.
Fancy new studio, mate.
We're going to see more of you around here, I imagine. Yeah.
For sure.
Yeah, for sure.
For sure. I think
For
the next epi, we've got one of our clients, long-term clients, who've got an amazing story about how she's literally, they've started with us, I don't know, maybe 7 or 8 years ago, and I think we're 5 or 6 properties into their journey. They've just recently sold one of their assets, buying their forever home with cash.
Cash money.
And are now raising a family, which they didn't have when they first started with us, and working part-time. Or
Sounds
the age
all right.
of about mid-30s.
Really?
Yep.
So it is possible. How expensive was their forever home?
I think they're going through the process of buying. I think it's the early ones.
Okay.
Early 1 millions.
So they're just sensible. This perspective thing, right?
Yeah.
They're thinking, my forever home needs to be a $10 million house,
No,
right?
no, we can't all be Philip Tarrant.
No, really.
There's only room at the top of that
There's only
band.
room at the top. Those prices are all coming down.
Oh,
They're all coming
good
down.
time to be shopping.
Maybe. What's the best way to track you down?
Mate, they can shoot an email to inquiry@purepropertyinvestment.com. Give us a call, 1300 985 428, or just get on the website. Purepropertyinvestment.com is probably the easiest way. There's a book now button where you can jump in, lock in a time with Aaron, myself, with Gerald from our team, with ideally the ability to talk shop about whether it's SMSF, whether it's personal name, whether it's just generally wanting to have a chat about the landscape and what they might want to or could do next, is sort of some of the key conversations for the rest of this year, because this is a time in the market where I think people can use this time very, very sensibly to plan, because we're not in a market that's going to speed off in any crazy directions. So, you don't have to feel like, hey, I need to do something next week. This is a time to, I think, be thorough, be ready.
So no be in a rush.
No, definitely not. But I think, book in to get that time to plan. And whether it's to plan the next 2 months or the next 2 years or the next 20 years, they're all the parts of really what we spend a lot of time doing.
And how does it work sort of if I want to chat to someone with pure property, can I choose who I get to chat to, or is it sort of...
Yeah.
Okay.
It's a choose your own adventure. I think if you jump on the website, literally you'll have the option, and the availabilities will differ, but you literally can go and book in with me, with Aaron, with Gerald.
Yeah.
You've got different accents. Aaron,
How's Gerard getting on?
He's good. He's still very French.
He's still very French. Is he still cooking stuff?
He's cooking up stuff all the time.
He's cooking up deals. Not culinary. He was a chef, right?
I think he's still definitely
still
can whip out a mean beurre blanc.
Cote de boeuf. Yeah, it's good.
Croquet bouche.
Yeah, nice. Well, it's good to have you on, Aaron. Let's see more of you around here. Paul, good to see you. And purepropertyinvestment.com.
That's the one.
Is how you track these guys down. Go and check it out. And if you've been considering, if you have missed this sort of cutoff for resi lending, it doesn't mean your super journey in property is over. So commercial property is certainly something worth considering. A little bit different to resi, different dynamics and nuances. But if you want all the facts and just to talk through the options, it's best to speak to people who know what they're doing. So I'd give Pure Property a call if I were you. We'll see you again next time on the Pure Property Podcast with Paul Glossop. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.